Hey everyone, welcome back to another video. And in my last video, we talked about down payment for different types of purchases. And in this video, we're going to talk about closing costs. Now, closing costs refer to all of the fees associated with purchasing real estate above and beyond the down payment. So not only does it encompass title, escrow, lender's fees, if you're paying any origination charges, any points involved, but also what's called prepaids. So these prepaids are prepaid taxes, insurance, and prepaid interest. And typically the total amount of closing costs is between 2 and 3% of the purchase price. So it can vary wildly. Now, lenders, escrow, and title are pretty heavily regulated. So you're going to find those fees are pretty similar between different companies. The real big question, there's a couple of them, but one is, are you paying points to buy down the interest rate, which is money that you spend up front to get a better interest rate? And also what time of year you're closing. In California, property taxes are collected twice a year. And if you happen to be closing your piece of real estate around the time that these 6 months are being collected, you could owe up to 8 months worth of property taxes. Why 8 months when they're collected twice? That should be 6. Well, if you have your taxes and insurance included in your mortgage payment, which is called having them impounded, then escrow is going to collect a bit of a cushion for you in case you happen to miss a payment. So that tax piece could be a large portion of your closing costs. So just be aware of the time of year that you're closing, because that could be a big varying factor of how much money you need to come in with for close. The other piece of the prepaids I mentioned was insurance. So you owe 12 months for your insurance premium for the first year. That's due right up front because the bank wants to make sure that your property is insured. From there, if your payment is impounded, again with the insurance, they may collect a cushion. So it could be a couple extra months for the cushion. And then as you make your mortgage payments, you're going to make that premium payment over 12 months so that when it becomes due again at the end of the next year, escrow's got enough money in their kitty to make that payment for you. And then the last piece of these prepaids is prepaid interest. So this one's a little tough. So bear with me, put your thinking cap on. So mortgage payments are paid in arrears. That means that you're paying for the last month that you lived in the property. For example, if you make a payment on February 1, that was for January. So when it comes to closing your loan, let's say your loan closes in January. Your first payment's going to be in March, and that covers February. But you owe the bank for the month that you moved into the property. So in this case, it would be January. So this prepaid interest covers the month that you closed on your loan. So if you move into the property, let's say your loan closes on the 15th of the month, then you owe for 15 days worth of interest. If your loan closes on the 1st of the month, then on a 31-day month, you owe for 30 days worth of interest. And that would be just, again, part of these closing costs. Guys, if you found any of this information useful, please hit the like button. If you want consistent updates on what's happening with the market and quick mortgage tips, please subscribe so you don't miss out on any of my videos. Thanks for tuning in. Send me a message if you got any questions, and we'll see you on the next video.